Here's a question worth asking, right? Do you aspire to be wealthy or do you actually want to be wealthy? What is it exactly, right? Because enduring wealth, the kind that grants you freedom, reshapes family legacies, and compounds over generations, rarely wears designer clothes or drives leased out supercars. It's built on just four timeless principles, simple but not simplistic. And those who master them, they don't just build wealth, they build permanence. Let's unpack each of these rules and how you can use them to secure financial independence for yourselves and those who come after you. So, the first rule for making sure that you have generational wealth is to live below your means. Now, what do I mean by that? The first principle, it's foundational, right? It's simple as it goes, saying living below your means. It's not a punishment, but it's a strategy. Because when your lifestyle pretty much lags behind your income, you gain control, you build optionality. The average person does not remain broke due to insufficient earnings. They remain broke because their expenditure scales up faster than their income. They mistake income for wealth, but wealth isn't income. Wealth is what you keep, wealth is what grows while you sleep. Consider this example, right? An individual earning $120,000 spends $110,000 and saves just $10,000. Meanwhile, someone earning $75,000 but living on $45,000 is saving triple, and they're doing it with peace of mind. So that's $30,000 in extra savings, even though you're earning almost over $50,000 less. So true wealth begins the moment you decouple ego from expenditure. Now, here's the tactic behind it, right? You automate a certain percentage of your income into savings and investments the moment it hits your account. If it's invisible, it's pretty much untouchable, and that's a good thing. That's one of the ways in which you can live below your means, and the tactic there helps you out. The second rule is to invest consistently. It's simple in theory and powerful in execution. Invest consistently regardless of market noise. Even though the current Middle Eastern tensions look like they're going to lead to the next nuclear war, don't worry about it. Keep investing. Not when the economy feels safe, not when influencers shout buy, but with disciplined regularity, week in, week out. Wealth isn't a lottery, it's a long game of compound interest and time. Here's another example. $500 invested monthly into an index fund with a 10% average return becomes 1.1 million over 30 years of investing. Delay starting that by just 10 years and you slash that final number by more than half. The cost of waiting is invisible, but it's enormous. Time is the one variable you can't track and you can't get back. The greatest investors don't try to outsmart the market, they outlast it. Here's a strategy to help you in that. Automate dollar cost averaging into index funds or quality equities. So every month, a certain amount of money keeps going in, whether the price goes higher or whether the price goes lower. Remove all of your emotion, let time work on your behalf, and you'll make money while you sleep. The third way of creating generational wealth is avoiding leverage. Now, it's counterintuitive in a world obsessed with speed, but avoid leverage. Leverage does magnify returns, but it also magnifies risk, often exponentially. Most people don't lose money from bad investments, they lose money from using borrowed capital on those investments. They don't grow broke because the market went down, they go broke because they could not afford for it to. Even Warren Buffett famously said, right, if you're smart, you don't need leverage. If you're not, you shouldn't use it. So leverage isn't just risky, it's fragile. It can literally burn down your portfolio overnight. It turns volatility into ruin. If your wealth only survives in good times, it's not really wealth. It's leverage dressed in optimism. So the rule of thumb to follow here in when it comes to leverage and generational wealth is if an asset is worth holding, it's worth buying with your own capital. You don't need outside capital to keep making money, right? The fourth rule that I would say to create generational wealth and for money to go across decades and centuries is a simple one, and that is own great businesses for the long term. Buy exceptional businesses and hold them for decades. Not because it's trendy, but because it's rational. Great businesses, those with enduring moats, consistent cash flows, and visionary leadership, are compounding machines. Simple example. If you had invested $10,000 into Apple in 2007, and simply held, you'd be sitting on over $2 million today. Along the way, there were dips, scandals, market noise, but fundamentals don't flinch. The lesson in this, ignore headlines, study fundamentals, and once you find quality, be patient. The easiest way out here is to approach investing like owning a business. Don't think of it as like renting a stock. You're Look at it more as an investment like a house where you buy because you don't want to sell it 3 months, 6 months, a year later, right? You're not flipping here, you're literally partnering in the likes of Apple, Spotify, Disney, Netflix. In conclusion, let me just go ahead and recap the four simple yet life changing rules. Live beneath your means, invest consistently, avoid unnecessary leverage, and own great businesses for the long run. It's not a hack, it's a framework. Follow it, and those who do with discipline, patience, and courage build wealth that endures. Generational wealth isn't loud, remember that. It isn't rushed. It's built with intent, nurtured with restraint, and guarded with wisdom. If this resonated with you, hit like, subscribe, and share it with someone building their financial legacy. And let me know in the comments which one of these four are you already living by, and which one are you focused on mastering next. Until next time, thank you.